Hello, everyone, and welcome to our January 2022 Seven Investing Team Podcast. We're back again. We've got several of the advisors here today to chat about a fun topic. There's a lot of market volatility going on right now. There's a lot of pessimism. Let's inject some fun into the system. Let's make some reckless predictions for the year of 2022. As a reminder, these are just reckless predictions. Please do not hold us to any one of these. We're trying to have a little bit of fun with it. But you never know what's going to happen in the year ahead. And our advisors like to chime in with some thoughts about that. I've got with me Nirban Mahanti. I've got Steve Simonton. I've got Dana Abramovitz and Max Chatsko. And I'm Simon Erickson. Steve, I'm going to start with you first and foremost, because I think I like your prediction the most out of everyone's. You're saying that small and mid caps are going to have a rebound here in 2022.
Right. And you asked us to give a reckless, kind of crazy, speculative prediction, and that sure seems like it would be crazy to argue that small caps, mid cap, tech stocks, growth stocks that have underperformed so badly, especially in recent months, and really there was a huge pullback. We've seen weakness for the better part of the last year in this group. And they tried to kind of stage a comeback. It kind of looked like it was going to happen even just a couple of months ago in November. But that's kind of one thing that I think could possibly happen is, we've seen a lot of these mega cap companies and a small number of sectors, energy and real estate, for example, have outperformed pretty drastically. And, I think maybe we get a little bit of a reversion to the mean, and you have some of those small caps, mid caps, and kind of previously richly valued growth stocks that have come down quite a bit, maybe do a little bit of reversion to the mean and play catch up in the coming year. So that would be fantastic, obviously, for my portfolio. So not an entirely selfless prediction, but we'll see.
I do love it, Steve. Now you follow the fundamentals very closely. We have a lot of small and mid-cap growth companies on the 7investing scorecard. Without mentioning names specifically of anything, but do fundamentals look like they're holding up? Has this been just kind of maybe valuations got ahead of themselves in 2021 and then they contracted the last couple of months?
Some of them were undoubtedly out of hand, kind of at the peaks that we saw. And, and there's a lot of comparison between kind of what's happening now to sort of an unwinding of like the tech or the .com crash. And it's been really interesting to kind of watch, because I think it is going to be an interesting next few months specifically. I was talking about this earlier, where I saw, the Twitter account, I think it was the Bespoke Investing Twitter account, pointed out that earlier this week was the sixth time in history that the S&P 500 had fallen more than 4% in a day and then closed in the green on the same day. And it almost did it the following day. That would have been the first in history, but it is historic volatility. So everybody's watching the Fed, and we just got some comments, from them today, kind of on how they're going to handle inflation and rate hikes and everything for the rest of the year. And it's going to be a weird year, I think, if it hasn't been strange enough already. But really just keep a level head, keep our heads down and keep finding what we believe to be promising businesses relative to their long-term potential.
Perfect. Thanks very much, Steve. Max Chatsko, let me come to you next. Let's keep a level head here. Let's balance out some of this enthusiasm and optimism. Your prediction for 2022 is that CRISPR and gene editing is going to become mortal again this year. What does that mean?
Yeah, it seems interesting, right? Because we've seen some valuations come down already significantly from what they were. But my argument is that I don't think investors have a great sense of just how crazy, especially in drug development, some of these valuations really became. In early 2021, we saw CRISPR Therapeutics launch to a $15 billion market valuation. That's crazy. We saw Intellia Therapeutics in June launch to a $12 billion market valuation. They released preliminary results from a phase 1 clinical trial. It's still ongoing, from only 6 patients that were tracked for only 28 days. $12 billion. We saw Beam Therapeutics go up to a $9 billion market valuation, also in 2021. It's not even enrolling patients in clinical trials yet. It's not even supposed to happen until the second half of this year. So I don't think investors have a great idea of just how insane that is. Like, for a drug developer to get a $10 billion market valuation, they usually need about $1 billion in sales or more per year. And these companies are still, some of them aren't even in clinical trials yet. So even though these companies might get drugs on the market, they might be successful, it's still years away. And even then, they're probably not going to be valued at $10 billion. So my reckless prediction for 2022 is that CRISPR stocks become mortal again. And I don't think any of them are going to end the year. Well, it's my reckless prediction anyway. I don't think any will end the year at a market valuation of $3 billion. So for that, we still need to see corrections of 50% for some of these.
Okay, everyone. Anyone who is enthusiastic after hearing Steve's prediction, we'll get rid of the enthusiasm for Max's prediction here. But let me double click on the valuation part of this here, Max, because when Steve and I are talking about tech stocks or most of the companies that are in the S&P 500, we're looking at things a lot of the times in terms of PE ratios, right? Price to earnings ratios. Sometimes in tech stocks, we're talking more about price to sales ratios. You don't have to worry about that in biotech because you don't have any earnings. You rarely, sometimes don't even have any sales yet. How are companies or the market in general valuing these early stage biotech companies that you're talking about?
I think they're just throwing darts at a dartboard, Simon. I think that's how they're doing it. How they're supposed to be doing it, though, is you take the risk adjusted net present value of pipeline assets. So there's a real value you can apply based on the probability that future cash flows, and I see Anirban cringing and squirming in his seat right now, the potential for future cash flows years away, and you can get to some valuations from there. But right now, I think there's just, certain companies deserve or have earned a premium. CRISPR is certainly one of them, right? It's something that a lot of people have heard about. There's a lot of excitement about it, rightfully so, I think, but you still need to be tempered. You still need to be grounded in reality because this is your hard-earned money you're investing. And if you're investing at $10 billion market valuations and, it might be years before any of them actually earn it. And some of them might never earn it again.
That's fantastic. I encourage everybody to look at some of the articles and the updates that Max has provided here on 7investing about the likelihood of success of drugs, of how companies are de-risking their portfolios over time. And that actually unlocks a lot of valuation. Always really great work, and I always enjoy it, Max. Thanks very much for the prediction. Anirban, he mentioned the possibility of potential future cash flows. Maybe we've heard of FCF as free cash flow. That's the PPCF new metric we're talking about. But let's talk about something a little bit more related to healthcare also. Peloton is a stay-at-home, workout from home company. You had a reckless prediction for them for something that might happen this year.
Simon, after reading my esteemed colleagues' reckless predictions, mine actually looks very much like a possibility. It's not reckless anymore. I did not know that I have to be that crazy.
And what is the prediction you have for Peloton? What does that mean, Anirban?
My prediction is very simple. We all know the troubles Peloton is having. Peloton, is having trouble selling its hardware. Its subscription side is still growing. There's calls for reduction of its workforce. There's calls for its CEO to disappear. Apparently, McKinsey is coming in. And the stock has completely catered. My prediction really is simple. I think there's some value in parts of the business, and I think connected fitness has a role in sort of the real meta world, not the meta world that some people talk about, but in the real meta world where we have augmented reality, we have connected fitness, we have connected wearables. I think in that world, connected fitness plays a role, and therefore I think it is an ideal acquisition for someone at the right price. And I'll give the example of Fitbit. Fitbit got acquired, but at the right price, not at its peak of its valuation, because I think connected wearables as a whole have a role to play, and connected fitness has a role to play. So my prediction really is that at the right valuation, it's going to get acquired. I would call that someone like Alphabet is going to be the one that's going to acquire it, because it's really steadily trying to build that connected fitness piece by acquiring this and that and trying to put it all together. That's my reckless prediction. But at the right valuation, maybe which another half from here, that might be the reckless part. Maybe it goes down another 50% before it's acquired.
Great point, Anirban. And now the valuation is not going to be based on the PPCF, the possibility of potential cash flows in the future. Like you mentioned, there is a subscription business to Peloton here. Seems like it's got pretty good retention rates, pretty good cash flows associated with it. It's just a problem of selling the bikes and figuring out the right price point. You think a tech company might be interested in the subscription part of this business, though?
Yeah, I think so. So I think, I mean, the subscription part of the business, I really think that these sort of things exist very well in bundles. So if you have a bundle and you're selling a bundle of stuff, among which one of them is a subscription to connected fitness equipment, connected fitness programs, I think that has a higher potential of success versus being, just a connected fitness offering. So I think that is the attractive part. They do own Precore, which I would assume that they're going to probably offload at some point. Probably before acquisition or after an acquisition. But yeah, I think that's the valuable component. Absolutely.
Fantastic. Thanks very much, Anirban. I encourage anyone listening to this podcast to come check out our 7investing subscription, 7investing.com/subscribe. We've got some good stuff actually behind the paywall with our thoughts about this market and kind of how things are playing out. I'd encourage anybody interested in the space to take a look at it. Dana, let me come to you next. And Anirban just mentioned the real meta world. Seems like those two are starting to become a little bit more blurred these days. And your prediction for 2022 is very much related to both of those.
Yep, absolutely. Yeah. So my prediction is Facebook, now Meta, moving into the healthcare industry. So, look, we've had lots of conversations about healthcare. And, it's interesting, I see so many people put information about their health on, they're just making a post about things. I'm done, this already, just, pick up the data that people are posting about their healthcare. But, as they build out into the metaverse and, use their Oculus and AR, VR capabilities, just applying that to healthcare. There are a lot of startups that are working on virtual reality just to kind of help people through like cancer treatments, health, so there is a lot of work. Right now there are a lot of startups, so we're not seeing them publicly traded just yet. But I could see, if Facebook, wanted to do something, I don't know, helpful and practical, then healthcare and using their VR and data capabilities, that might be a way to do something in healthcare.
It certainly wouldn't be the first tech company interested in this. When you look at kind of Fitbit and what they're trying to accomplish, and then Google, of course, they're interested in that, and Google's trying to kind of decentralize healthcare outside of the hospital too. It seems natural Facebook would have an interest in this. Do you think that consumers or the population has still got issues with the privacy concerns with Facebook, or is that starting to become more accepted?
Well, that's the thing, is that, I see people, posting things about their healthcare that, so I'm a very private person, and, anybody, most people know that I barely post anything on social media, as much as Simon tries to get me to. It's really, so yeah, but there are people that share a lot of information, and it always surprises me. But I think some people are very comfortable doing it, or have just kind of given up in some way, or at least for healthcare or some kind of post, because you see people, updating their Facebook page with, I was vaccinated, or I'm not vaccinated, or, I have these, whatever. Facebook has given people the means to share, and you'd think that they, have also those means to collect the data and then do something useful with it. So, that's again why I'm surprised that they haven't actually gone in that direction. But, if that's something that they wanted to do, I think it would be just a pretty easy pivot for them to make.
Absolutely. Thanks very much always for sharing too, Dana. Like you said, private person, but we all learn a lot from you every time you do post about healthcare. Side note too, that I've known Dana for a long time, and we've met up for several years at South by Southwest. So awesome having her on the 7investing team now. Her recommendations really are making the world a better place. Healthcare is one of those fields that's special, that you can see the progress. You're cheering, you're rooting for those companies to succeed because they are improving the entire system. Certainly Dana's January recommendation was definitely one of those companies too. And without naming names, I think that February is definitely aligned with that mission as well. Thanks very much, Dana. I'm going to throw in one more into the hat here of a reckless prediction for 2022. I'm going to I'm going to predict that the United States, the SEC, is going to ban payment for order flow as a practice in 2022. A little bit of a review of what this means. We're starting to see these zero commission brokerages, Robinhood and others that are popping up. And they say, hey, no more trading fees. Great, go ahead and go out and buy stocks, and it's not going to cost you anything for a commission. And of course, that's good for us in theory. We don't have to pay commissions for trades, so that's money in our pocket. But there's been some unintended consequences that have risen from this. One of them is payment for order flow, where the brokerages themselves are not actually sending those transactions directly to be fulfilled by the exchanges. They're actually being fulfilled by high-frequency trading middlemen like Citadel Securities, which are sending a kickback, if you want to call it that to the exchanges for sending in the orders to be transferred. And of course, this is front-running the market a little bit. You've got the pricing and volume data for those companies that are getting access to that before anyone else is. And that's kind of causing some problems out there, right? Citadel Securities managed 47% of retail transactions last year. 47% of retail stock transactions were handled by Citadel Securities last year. Of course, that's a private enterprise. That is not the exchange. This is something that is bad for consumers, in my opinion. This is bad for retail investors. The practice as a whole was outlawed by the United Kingdom back in 2012. And 2 years later, the CFA Institute supported those claims as well, saying, hey, if you really want to get transparent pricing and the best pricing for individual investors, this is a practice that's probably going to have to go. And so the SEC has taken a close look at this for several years now. I think that 2022 is going to be the year that they finally say, nope, we're done with this. Let's follow suit. Let's do what Canada did. Let's do what the UK did. Let's ban payment for order flow and get rid of a lot of these kind of hidden incentives that are bad for investors everywhere. So quick recap of our reckless predictions. I'm predicting an end to payment for order flow in the United States. Dana is saying that Facebook, the company formerly known as Facebook, now Meta Platforms, is going to enter the healthcare industry. Anirban says that Peloton's going to get acquired out there. Max Chatsko says that CRISPR and gene editing companies are going to become mortal once again. And again, my favorite of all the predictions is Steve Simonton's that we're going to see a small or a mid-cap rally here later in the year. Again, reckless predictions. These are not to be held at 100% accuracy, but we do have some fun with them each and every time that we do these. So thanks for all of my other fellow lead advisors who have contributed to this. Today is January 26th, 2022. We're just a few days away from issuing our newest February recommendations at 7investing.com/subscribe. If you would like to sign up and see those will be issued on February the 1st. So thanks very much to all of our advisors for joining this podcast. Thank you for everyone for your interest in 7 Investing. We are here to empower you to invest in your future. We are 7 Investing.